All right, here we are at part 2 of our video on fiscal policy. This will be a short one. Basically, last time we saw that fiscal policy can be used to close gaps by impacting aggregate demand. You can use expansionary fiscal policy to close a recessionary gap, or you can use contractionary fiscal policy to close an inflationary gap. We noted there are two significant problems with fiscal policy. The first is the potential for crowding out, and the second are lags. The severity of those two problems depends on your philosophical and theoretical mindset. Most Keynesians or neo-Keynesians do not really believe that crowding out is a problem. Obviously, in the most recent couple of years, we've seen that lags can be a big problem, especially in an election year. Trying to move anything through Congress on the economy can be tough. So lags definitely do exist. Today we're going to take a quick peek at the other arm of the model, and that is aggregate supply. So can fiscal policy affect aggregate supply? And the answer is yes. And this is called supply-side fiscal policy. The main focus here is on taxation issues. And the thing you have to look at is the impact of changes in the marginal tax rate. Now, the marginal tax rate is simply the percentage change in your taxes paid divided by the percentage change in your income. In other words, if you get a $1,000 pay raise and your taxes go up by $400, then your marginal tax rate is 40%. So that's what we're looking at with supply-side fiscal policy. Now, the issue is what happens to aggregate supply if you were to change the marginal tax rate? Well, according to supply-side theory, they would say that if you reduce the marginal tax rate, this will then free up firms who can then purchase more labor, purchase more raw materials, and therefore this will increase aggregate supply. It also encourages people to work more. So if they give me a tax cut and I get to keep more of my money, then I'm willing to supply more labor. So again, these are things that impact the short-run aggregate supply curve. And in the opposite case with a tax increase. If there's a tax increase, then I get to keep less of my money, so I'm going to supply fewer labor hours, and therefore firms cannot hire or use as much labor as they might want, and so this can then shift the short-run aggregate supply curve to the left. So again, you can have basically expansionary supply-side policy or contractionary supply-side policy based on whether you're increasing tax revenues or tax rates or decreasing tax rates. As far as the long-run supply curve goes, which is the line that we've always drawn vertical at full employment, do tax changes affect that? The answer is it depends on if the change is perceived as being permanent. So if the tax cut is seen or the tax increase is seen as being a 1 or 2 year thing, then it may not really impact full employment that much. If, however, it's seen as being permanent, then you could shift the long-run curve left or right depending on whether it's a tax cut or a tax increase. So the impact in the long run depends on whether it's perceived as being permanent. Now, the major issue with any form of taxation change is revenue. If you do a tax cut, does that always mean you're going to get less revenue? If you do a tax rate increase, does that always mean you're going to get an increase in tax revenue? And the answer to that is no. And the curve that's usually drawn to show this, which we have done in our class, is the Laffer curve. And what the Laffer curve does, and that's L-A-F-F-E-R, is show a graph showing that as tax rates change, what happens to revenue. And according to the graph and the model, it is possible that if you raise tax rates, you will get more money. It also is possible that if you raise tax rates, you may get less money. It all depends on what the current rates are. In other words, when your rates are low and you increase tax rates, you'll probably bring in more money. However, if the tax rate is already pretty high and you raise rates, all you do is discourage people from working, and so you actually take in less money. You know, for example, if the tax rate was, say, 70% and they jumped it to 95%, how many of you are going to be out there working extra hours? Not me. So the tax revenue would actually fall. Conversely, according to the Laffer model, There are, again, depending on what the rate is, if you cut taxes, it is possible that you will gain revenue. Or if you cut taxes, it's possible you will lose revenue. It all depends on what the current tax rate is. So again, you just have to look at the law firm model to see examples of how this would happen, and we've done that in class. So again, the moral of this on the supply side issue is, instead of focusing on spending, you should focus on production. So the Keynesians mostly emphasize spending changes, aggregate demand, and fiscal policy targeted toward that, whereas the supply side people believe you should target more efforts toward taxation issues in order to change aggregate supply. So again, a difference in focus between supply side and demand side. Now, how has this been handled in the past? Well, if you look at things that have been handled in the past, you would say it's been done differently as recessions have happened. For example, if you look back in the 1920s, before the Great Depression, there was also a recession, and that recession was handled differently than the one that happened in the 1930s. For example, during the 1920s recession, when Calvin Coolidge was president and Andrew Mellon was the Secretary of Treasury, what they did is they actually cut government spending, cut taxes. So the opposite of what we've done recently. And if you look at the results were an increase in government revenue, a reduction in unemployment, and they paid off 30% of the national debt. So you don't always have to spend more money to get yourself out of a recession. So again, that takes care of our brief look here at fiscal policy, part 2. Next time we'll look at money and banking.